Good morning. We are half an hour from the opening bell. Hong Kong, Shanghai, and Shenzhen. You're watching The China Show. I'm David Ingles, live at the UBS Asian Investment Conference here in Hong Kong.
And I'm Yvonne. Our top stories this morning. Asian stocks track Wall Street's biggest rally in more than 2 weeks. Sentiment boosted by a rebound in U.S. consumer confidence and a global surge in bonds. Chinese tech in focus, though, after Xiaomi's first quarter sales beat estimates, but PDD tumbles as the trade war hits revenue and profit. Also ahead, Premier Li Qiang calls for China and Asean to develop a big market as Beijing works to build regional influence. And the SpaceX Starship spins out of control after a rocket explosion in its latest high-stakes test failure. We're expected to hear soon from the CEO, Elon Musk. Well, what a difference just a few days makes here when you take a look at what we're seeing with U.S. markets reopening and really coming back with a bit of a vengeance here in this recovery, right? We saw one of the best days in about 2 weeks for the S&P, and certainly that helped boost sentiment. You mentioned about those consumer confidence numbers in the U.S., and partly because what we're seeing in Japan, that we are seeing this global bond rally take place, right? So ahead of that crucial 40-year auction, we heard from the Ministry of Finance possibly looking at how to adjust supply, right, and talk to some of these, institutions and the like about what issuance is going to look like. That certainly is stoking a lot of interest and what this sort of 40-year auction is going to bring a bit later on. Bonds are pretty steady after that big drop in yields on the long end of the curve yesterday. The 40-year yield in Japan tumbled some 20 basis points. You're seeing the U.S. 30-year yield also back below that 5% threshold here right now. So we're pretty steady right now in terms of treasuries, though. Keep in mind, we're watching very closely. The dollar was actually bid up as well. And so we're watching very closely how this sort of sell America trade has definitely taken a pause button. How long it will last is certainly a big key question moving forward, but we're pretty flat in the Bloomberg U.S. dollar index here right now. Gold is catching a slight bid here this morning. So maybe things are looking a bit of a reversal, but keep in mind stocks are doing quite well, right? So Asia Pacific is up about 0.5%. Taiwan's coming back online and we're seeing gains of more than 1%. The Kospi is actually at a 2025 high right now. So stocks are continuing that rally, but really what we're focusing on is going to be bonds the next few hours or so. Let's take a look at how the JGB market is doing in Japan. We mentioned about what treasuries are doing, and yields are actually ticking up higher. There you go. Across the long end of the curve, we are seeing a slight reversal, just very slight here. We're at 335 levels for your 40-year yield. Certainly a lot of questions. We heard from Ueda as well, the Bank of Japan governor, talking about, they're going to be tracking very closely that long end of the curve. What does that tell us about what the BOJ is going to do? That certainly is going to be a key question. And then here's a setup to China, right? You take a look at what we're seeing in terms of the earnings side of things. Two different stories, right? When you look at Xiaomi, which actually delivered on when it came to results. PDD, on the other hand, really goes to show how competitive the whole sort of e-commerce space is, in particular there, how they're being hit by tariffs and the like. We'll see how that fares for some of these consumption plays here in China today. But futures are punching slightly higher this morning, 718, just below that 719 level for the currency, Dave.
Yep, there we go. Lots to watch today. As Yvonne is pointing out, it's bonds on deck today. Let's bring in Paul Dobson, our executive editor for Asian markets in Singapore for us. Paul, equity markets, we know they're doing well. They have done well. They've more than recovered. It's the bond markets, though, telling us a very different story, particularly on the long end. What's the conversation within your team today on how we need to be looking at price action this Wednesday?
Yeah, the conversation is, can you remember a time when a Japanese government bond auction had this much media attention, this much investor attention as we've got today? Probably can't remember that many instances myself. People are very interested to know whether buyers will show up for the 40-year. It's those longest maturity bonds that have been the ones that have come under a lot of pressure recently. While yields have been rising and actually offering a positive yield even after inflation, still they're not high enough for the likes of the large insurers to be piling in there a little bit more aggressively because of those concerns about the supply-demand balance. So it was pretty significant what we learned yesterday, that the authorities are polling buyers, participants in the auctions overall on what they think the balance between the short and the longer term issuance might B, the implication being that they're willing to reduce the amount of volume they're putting into the market on those long-term bonds going forwards in order to sort of stabilize the market. So that gave the markets, that gave investors hope yesterday, and that's why we saw that big rally in the market. Now we'll be watching very closely what today's sale looks like just after 11:30 a.m. our time. We'll be watching very closely the bid to cover ratio. We'll be watching the tail, how much of a difference there is between the lowest accepted bid and the average to determine what that sort of demand there looks like. And because the moves have been so extreme in recent days, it's not just been the JGB market that has moved off the back of it, but it's also had an influence on global bond markets, including US Treasuries. So a lot more interest than there might otherwise be. And even from the equities side, people are starting to talk about whether those higher yields could be damaging over time. And so there's a little bit of interest, even spilling over into stocks as well today.
Paul, yeah, and it seems like, as you say, right, it's catched a bit of bonds. Even the dollar was bid up. Stocks are certainly taking it as good news in some ways. But I'm just wondering, this sort of sell America trade, we hit the pause button for now, but how long do you think it's going to last?
Well, it seems like there's definitely a very long-term view on that, as well as a shorter-term view, Yvonne. So we have this story out today talking about, just the amount of inflow that there's been into US assets from the rest of the world and Asia in particular over the last 20, 30 years. The holdings of treasuries have ratcheted up. The holdings of corporate bonds as well. And of course, the holdings of US equities in particular, which have been outperforming. It's been a good idea to be doing that. You've got the appreciation of the dollar alongside the gains that we've seen in the S&P and particularly the Magnificent Seven US stocks. But now people are starting to have that sort of taking stock moment. The US doesn't look quite so appealing. There's more attractive options around the rest of the world, potentially on a valuation basis, on a growth potential basis as well. And people are a bit miffed, frankly, with the activities of the Trump administration. So those long-term flows, that rebalancing away from the US and across the rest of the world, seems to be a long-term theme, a mega trend maybe, that we might see playing out not just over the next few months, but over the next few years. And maybe so that's a longer-term trend. And of course, there will be ups and downs along the way, very much dependent, I think, on how the tariff policy plays out over the next few months. But it does seem that there's this entrenched view within the market that it makes sense to reduce holdings of US assets relative to the rest of the world. And that's we're just getting to see the starting of that this year.
Paul, thank you. Paul Dobson there, our executive editor for Asia Markets, joining us out of Singapore. Forgot to mention, we also have an RBNZ decision that's happening at the top of the hour as well. On top of that, we're focusing on the earnings side of things, and we're watching shares of Xiaomi at the open this hour. The tech giant posted a revenue beat for the March quarter with growth across key business divisions. For more, let's bring in our reporter, Annabelle Jewelers, on what really stood out in these numbers.
Well, it really stood out just I think, the high expectations going into the numbers, especially when you've had such a big run up in the stock over the past several months, but they actually managed to meet those expectations as well. So thinking about the revenue overall, so the expectation was that we'd see 109 billion yuan for the March quarter. They actually topped that, so coming in at 111.3, so that's $15.5 billion. But then also breaking it down and looking at the different divisions across the business as well. So EVs, of course, stood out. They said that they delivered around 76,000 EVs for the period. They've got very ambitious targets for 2025, so 350,000 vehicles. They're saying that they can meet that. Where the performance, though, really was strongest was that IoT division. So this is really the home appliances, the wearables as well. Very strong growth in that, up around 60% on the year, and as well really benefiting from that trade-in program from Beijing, which also benefited smartphones. You can see there they still managed to have shipments growing 40% on the year at home. Yeah.
On the flip side, though, look at what happened with PDD overnight, and the shares were really tanking on the back of these earnings, and really you're seeing the impact being felt from this trade war.
Yeah. Well, I think PDD as a business is very, very sensitive to the trade war. Of course, they're the owner of Temu. And so things like tariffs, things like the end to the de minimis exemption as well, really has a big bearing on their bottom line. And so the company is really struggling with how to counter this, and they actually said that in the earnings call. They're going to be putting a lot of investments into trying to adjust to the new normal and to think about ways that they can get around this. So maybe they're finding supplies outside China, for instance. That could be a way to get around the tariffs. But they did say it's going to have a big bearing on their business, not just in the shorter term. It actually could hit profitability even further out as well. And so you're seeing that being reflected in the Wall Street share price performance overnight. But analysts are saying that the performance could be revised down by around 30% as a result.
The big one is NVIDIA, obviously. Analysts have started trimming their sort of earnings forecast for this quarter because a lot of it has to do with what we've heard from the company itself, that $5 billion write-down when it comes to the sale of those H20 chips.
H20 chips, to China. Yeah, that's definitely going to have something that shows up in the numbers later today, and it has been, of course, a big hit for them in this reporting period. I think also going into the year, there was a lot of concern that there was going to be lackluster demand, or maybe we'd sort of hit peak demand. The company has sort of been brushing that off, but it's definitely going to be, of course, the big focus. How much demand is there for AI infrastructure, and that's going to also give us a sense of whether that spending is sustainable. What's interesting, though, is you saw NVIDIA gaining into the numbers, and that is playing out. You're seeing those chip makers and big suppliers to NVIDIA that are also rising today.
Belle, great stuff. Thank you so much. Belle there with a wrap of the big tech earnings plus the big one coming through later today. Right, speaking of tech here, I'm just looking at my phone, and the latest here coming out of Elon Musk in a post on X here. So, I mean, this is really what you get. It's really in the nuance when you're pushing the frontiers of what's possible in terms of space flight. So an update here, the Starship did make it to the scheduled ship engine. Big improvement, he says, over the last flight. No significant loss of heat shield during the ascent. That's point number one. Point number two is the leaks caused a loss of main tank pressure during the coast and re-entry phase. They have a lot of good data, which they then work into what I now can just deduce to be the next phases here. He finally ends by saying that the cadence for the next 3 flights will be quicker, more frequent, at approximately 1 every 3 to 4 weeks. That's an update there from Elon Musk on X. Right, counting down to the open of trades, just what, under 18 minutes away? The opening bell here in Hong Kong, in Shanghai, and in Shenzhen, and yet gloomy, overcast, and a forecast of rain with no chance of meatballs. 17 minutes away, futures are called higher. This is the China Show. Good morning.
Nothing's really changed in the economic environment. You just have policy uncertainty. And I think people are just going to wait policy uncertainty out. They do think there's a light at the end of the tunnel, that there will be some certainty, whether it's the tax bill or some of the trade terms. But I think they're just waiting it out.
That was Tom Barkin there, Richmond Fed president, speaking exclusively with Bloomberg. Really goes into the conversations we've had here at the UBS Investment Conference. We had Iqbal Khan talking about how, the head, of course, of UBS here in the Asia Pacific, how this is really an environment where you need to diversify. We don't know where things are going to settle. It just makes sense to sort of diversify your bets. We had Raghuram Rajan, who I believe is speaking right now on the stage behind me. And he basically mentioned it's useful to game scenarios, but again, the scenarios you're able to game right now, there's so much variance in between what's possible because things are basically being negotiated as we speak. So how does it all play out as far as the Chinese economy goes? 30% tariffs, 90 days, front-loading, growth, inflation, everything in between. Joining us here on set is Wang Tao, the bank's head of Asia economics, of course, to take us through how they're gaming scenarios out in this sort of environment. Nice to see you.
Nice to see you. Thank you.
We were just joking right before we came on air that you didn't change your forecast as much as some in the industry.
Right.
So you're currently at 4% on growth in China.
Yes, we are at 4%. We started the year at 4% because at the time we expected 60% tariff later in the year. So when the tariff escalated to 145%, we downgraded to 3.4, and after de-escalation, we're back at 4%. we're comfortable with the current situation. But as you said, there's so much uncertainty. Right now, it's a good thing. We had a de-escalation from both sides.
Yeah.
We have a 90-day sort of suspension period for them to discuss. Nobody expects tariffs to go back as high as before, but how much will it settle? Nobody knows. We think that the 20% fentanyl-related tariff may be negotiated away. But however, there could be additional tariffs on certain sector products like semiconductors, electronics, pharmaceuticals, and so on and so forth. So in the end, the tariff rate may still be more or less, what China is facing now, but with different composition. And then it's also very important what tariffs the U.S. impose on other countries, because relative tariffs matter, right? So if everybody is the same, China's competitiveness will not be changed. If China's tariff is much higher than others, could be a siphoning effect of supply chain moving away.
What are you seeing now in terms of front loading? Are you seeing any front loading of shipments, whether that's from China to the U.S. or from other places to the U.S.? Because that matters, really.
Yes. Indeed, we have not really seen export numbers from China, from Asia being hit very hard. And a big part of that is front loading. So Chinese exporters obviously had incentive to ship as much as possible. But we also noticed Chinese exports to ASEAN, for example, and ASEAN exports to the U.S. in April, both are very strong. So that's ASEAN and others using that
the corridor
of suspension, shipping as fast as possible, and they are giving China as a big part of the supply chain. They're demanding inputs from China as well. So this whole supply chain has seen front loading. We could still see this going on because we again have a suspension period.
Yeah.
So we could still see this going on for some time. And so then maybe only a few months later, we see a very notable drop in exports, in orders, in shipment. For a lot of businesses, it's really a period of high uncertainty. For people, what to order how much. The exporters know the order from their buyers is ship as fast as possible.
Yeah, get them in.
Get them in. Yeah.
And that really tells us about the payback we'll see in the second half, because we're pulling forward economic activity to the first half. So how are you looking at the second half?
Second half, we do see a very notable slowdown. So we think that for our quarterly scenario, right? So the second quarter, we may still have 4.6% growth, but for the whole year, we have 4%. And the first quarter was 5.4%, right? So you see growth sharply coming down. So that's because we see exports really dropping later. And also because of this uncertainty related to business, then corporate capex is going to drop. And also that's going to affect consumers, confidence and so on. And all this will also have a negative impact on the already ongoing housing sector that has been trying to find the bottom. And now I think that stabilization is put in doubt by the external shock as well.
How would you describe the housing sector recovery right now?
Right, the housing sector had shown signs of improvement since end of September, October last year, with the government putting in some stimulus measures. And so the first quarter was pretty decent. April, we already saw signs of weakness. May, so far, we only have the sales of the top 30 cities.
Yes.
That's less bad compared to April, so that's okay. But we need to see a couple more months of data to say whether housing has stabilized. Our current baseline is that housing probably will stabilize at the end of this year or beginning of next year.
What visibility do you have then on consumption?
On consumption, I think consumption, because of the trade-in program that's been going on, so we have seen pretty decent sales in automobiles, smartphones, appliances that are benefiting from these subsidies. But overall retail sales and so on is still a bit subdued. So anything not related to the subsidies is relatively weak. So at the moment, I think we don't really see signs of consumption picking up as a whole, if you strip the
trade-in away.
The trade-in. So therefore, I think for the government, next step is they probably need to prepare more money to supplement the trade-in program. At this pace, some of the planned money may be used up by the summer, so they could do more. We are expecting another couple of $100 billion, for example. So in our 4% GDP forecast, we are assuming 0.5% to 1% of GDP of additional fiscal stimulus coming in, and that has been relatively slow, but we think it's really necessary.
Okay, and it might come, to your point. Where does it leave inflation then? And how accurate is inflation now a gauge of demand? Because to your point, we've had trade-ins, we have all these corporates, we're in the middle of earnings season, and they're all talking about margins and the needing to lower prices. And I'm wondering how those two things now come together to form an economic picture.
Right. So overall, I think the GDP deflator is still negative. So that measures the broad inflation or deflation. CPI hovers around negative, right? So it's still negative, but sometimes up down because of the base effect.
Yeah.
But in general, thinking of China's economy, it has very strong supply. At the moment, demand, external demand, export demand was very strong, and now but hit by the tariffs and by the shock. So basically, that demand shock is going to add deflationary pressure to China. So we're going to see very weak prices in the next few quarters.
Okay. Well, to your point, we might get fiscal at some point in the next few months.
Yeah, fiscal. I think fiscal stronger effort to try to destock the property. And also some rein-in of excess capacity, including in the steel sector and so on. That could potentially help adjust this supply-demand balance and stabilize prices in general.
That's the outlook. Thank you so much. Wang Tao, their head of Asia Economics and Chief China Economist there at UBS. Some forward-looking indicators to watch there as far as the more fiscal support coming through, maybe as early as the summer. Plenty more ahead here on The China Show.
When you were elected chairman of the Ways and Means Committee, did you call your mother and did she tell everybody her son is the chairman of the Ways and Means Committee, or she doesn't?
She doesn't. Like, people don't care.
Don't care.
How much does the geopolitical volatility emanating from the United States perhaps undermine the bull case for Mexico? Is that a scenario you've plotted out?
Structurally speaking, we do still have a very positive view in Mexico. On the macro side, it is a very attractive investment geography for the U.S. Mexico is hugely competitive in terms of costs. The wages in Mexico are much more competitive than the wages in China. So why would the U.S. companies not take advantage of that?
And this structural cost advantage is going to lead Mexico to continue to contribute to the growth of U.S. as well. The value chains, the supply chains are so integrated that Mexico has to play a continuing role in the further development of the U.S. And U.S. is growing very healthily, very nicely. It will benefit Mexico. This way or that way, it will benefit Mexico.
Mexico for VBA is, a source of resiliency of earnings, and it generates, it complements the diversification that we have from the footprint. But there's another topic that is very important, which sometimes we don't focus a lot about, and why we're so convinced that Mexico is going to continue to do well, which is the leverage in the country. Because the leverage in the country is only 33%. And when you've seen Mexico grow and BBVA grow in Mexico, structurally speaking, the leverage is so low that just a little bit of growth in the leverage is going to be able to support that bull case in Mexico. So that's why we're structurally positive in Mexico.
Pre-market is flat right now. We're watching the tech sector in particular, with the likes of Kuaishou really leading the charge there when it comes to HS Tech on the back of their beat on earnings as well. We're also looking at some of these analyst actions with PDD targets being slashed on the ADRs and the likes of Jefferies from China Renaissance as well. A call from PopMart there rated new outperform at CCB, and Hua Hong Semi also rated a new outperform at Daiwa. We got the market open coming up. This is Bloomberg. Welcome back. You're watching the China Show. We're counting down to the open of markets. And obviously, globally, we're seeing a risk is on here this morning after what we've been seeing in the U.S. coming back from that holiday here, seeing the best week for U.S. stocks in 2 weeks. The global bond rally. Yeah, we're talking about a rally now after what we heard from, well, what we might see them chatter from the Ministry of Finance when it comes to adjusting supply of JGBs. That certainly has calmed some nerves leading up to this 40-year bond auction in Japan. We're seeing the Hang Seng pre-market is pretty much flat here this morning, but we're watching very closely earnings. Just given what we're seeing in the tech sector, the likes of Xiaomi, PDD as well. And then again, yeah, a lot of it was a pretty mixed picture, pretty much, Dave.
Yeah, and the other one too coming up, right? In NVIDIA, and I think I'll use that. Yeah. I'll use that preview to plug the guest coming up here in shows, which is Andrew Garthwaite, of course, who's the head of equity strategy globally at UBS, and their thinking is, don't go overweight the United States. So I'll get his thoughts really on what scenarios are in that respect. Okay, we now have the Australia CPI print. We also have a bunch of hotel staff just walking past in case you heard that noise. It is a very crowded conference here. Yeah, okay, so they're bringing in more plates here for breakfast. Okay, speaking of breakfast, the breakfast basket, inflation basket in Australia here, April numbers are coming in 2.4% to the upside, slightly ahead of the estimates here at point of 2.3. We're also looking at the trimmed mean inflation coming in at 2.8%. That's also for April. That's a year-on-year figure, and I guess it goes into still quite far away though. Just about seven weeks from now, of course, is the next, Yvonne, the next RBA central bank decision there.
Yep, and we got RBNZ coming up here, expected to cut rates for a 6th straight meeting. So certainly is one to watch here at the top of the hour. In the meantime, taking a look at when it comes to Hong Kong as well, right? You take a look at what we're seeing, the follow-through from Wall Street, the follow-through from Asia. You're seeing the likes of Japan, the likes of Taiwan, they're doing quite well here today. Hong Kong seems to be also doing okay, right? You take a look at how Hang Seng is doing. We're up about 1/5 of 1%. HS Tech is solid. Quiet show is certainly one of the key themes to watch here with earnings there. Did deliver and beat the street. Same with Xiaomi as well. We'll watch and see how those shares are doing. There you go. We're up some 2% for Xiaomi. So despite some pretty lofty expectations leading up to this result, it looks like they did deliver, right? With sales beat estimates when it comes to the EV and smartphone growth for that company as well. Meituan, though, heading the opposite direction. We're down some 1%. And Alibaba as well, slightly to the downside here this morning. So there you go. A decent session there happening when it comes to Hong Kong. Let's take a look at when it comes to earnings of one particular company as well. We're talking about a Chinese online knowledge sharing platform, Zhihu, has reported a 24% fall in first quarter revenue from last year. That did beat, though, analyst expectations. Also, first quarter non-GAAP profit since they started listing, right? The company, sometimes called China's version of Quora as well, the Q&A platform. For more, let's bring in Zhihu CFO Han Wang, who joins us from Beijing. Han Wang, great to have you back on the program. Run us through the earnings as well, right? You mentioned about first quarter non-GAAP profit that we're seeing first time ever, but also that drop in earnings. Tell us about revenue, I should say. What stood out to you?
Well, yeah, it was the first time that we break even in Q1, which is the low season, right? But actually, we done a great profitable in Q4. We have our margin more than 10%. We were double-digit profits last Q4, right? So actually, we're very comfortable with our strategy shift. Right, so we used to all this internet platform used to grow user metrics, penetrate to lower tier cities, but actually AI gave us a great opportunity for us to focus on our high quality users, well educated users, and actually because AI will take this high quality content as the most important assets. So we just focusing on the AI technology and our AI opportunities, so we just being profitable very easy because of this strategy shift.
Yeah, you shift from basically sacrificing your top line growth for profitability. Tell us then, Han Wang, what sort of levers, what sort of the revenue drivers are going to be crucial then for you to actually be on a very sustainable path to profitability?
Well, actually, so this is actually our transition moment. So actually we don't want to. So we were losing a lot of money last year, we lose almost like more than $100 million last year, is because we try to accumulate like more users from like lower tier cities to get like bigger MAUs. But actually, we now shift our strategy, because you can see Reddit, like people take them as a, like an old school like company, like years ago. But now after AI, actually it's people think it has great opportunity in the AI era. So we think it's the same. Everybody, when people talk to me, so actually I'll give you an interesting fact. So when I just didn't take this job as a CFO, or many people congratulate me to be a CFO, but also they say, oh, I'm also feel sorry for you, because you just joined a company that is like a little bit famous for hard to monetize, but actually recently it's different. More and more people say that, oh, you just got a great opportunity in AI. Or just look at Reddit. It's just like, right, this stock just go up a lot, right? So you have the same opportunity. So it's just because of these data assets that has given people all this like potential like AI opportunities. I think we actually have more like opportunities than Reddit, is because actually our brand image in China, we got more a piece of LinkedIn or X, because our users are more like they have public professional profiles over here, and people like think us we are you know, a lot of like CTOs, doctors with their they put up their professional profile on our platform, so people can see that, oh, this is actually from rich professional people, and they just feel more comfortable to trust in this content. So actually this will solve the AI hallucination problem a lot when people are using these AI tools.
Yeah, talk us a little bit more about the AI tools, right? Zhihu, this is your new search add-on. What progress has been made in terms of, you know, projections for ad revenue, for example? Do you have any numbers set in place once, you know, ZZ does gain some traction?
Sure. Yeah, we just launched a couple quarters ago, but now it's been more than 10 million users, like per month. And actually, just within this quarter, it's growing like 37% from the first of the quarter to the end of the quarter. And like we got more and more good feedbacks from the people. And actually, there's also a recent survey that actually people care more about where this data coming from. So you know, there's all kinds of AI chatbots, and they're citing source all from the internet. But actually, from the survey, we rank the top among all the sources that this AI chatbots are sourcing. So, and actually, we are way higher than number 2. We rank like the top and 4 or 5x higher than the number 2. So we are just the source of the truth or more trustworthy content. And so within our site, within our AI search engine, so actually it's more integrated with this like community with real experts in there. So every sentence you see from this AI chatbot actually can source back to a real person with professional background, and you can see what he talked before, and you can also follow on what he will talk in the future. So that's our differentiation.
I mean, a lot of analysts have talked about, you know, a risk for the company is the way you diversify your revenue streams. I'm just wondering, with the AI function, is there any plans at all to actually charge a fee for the AI function in any way?
Well, actually, you know, all these people are like exploring the AI monetization, but actually no one has been like really successful here, right? And you can tell a lot of AI like companies didn't, well, they try a little bit monetization function, but not a lot of them are being sustainable, right? So now we are just like focusing our own path to integrate AI with our own content and community. And I think no one has that. And the only thing we can have a little bit comparable is like X, when they combine their Grok with their community. I think it's the same. And you can tell a lot of companies are trying to do community with their AI tools, but actually, you know, accumulating all these real experts for like 10-ish years, I don't think it's easy for them to do. So yeah, so I think integrating AI with our real human experts with like 10 years content and professional network, there's a network effect over there, and I don't think a lot of people can have that.
In terms of risks, then, I'm just wondering, Hao-Wang, what do you think is going to be the biggest risk for the company in the next 6 to 9 months?
Well, actually, we just want to, this is a time. You can tell that the more professional, in-depth content can become really important in China. Previously in China, all these analysts, all these investors, they look at all these social media companies. They only look at in one way. It's just bigger DAU, bigger MAU, more time spent, more LO, more advertising. Now it's different. Now AI will change this paradigm and will shift the focus from all this user time and user amount to the highest quality of the content. So now AI will give the highest weight to the highest quality content. That is actually our opportunity, and we can take this opportunity and attract all these professional people came to us. We are the only online platform that people can come to us and publish their professional insights, and then accumulate their public professional tracking records and credits. So and then when people search on the AI thing like later, and they can always come from maybe one expert's content came up and ranked number one. People will take this opportunity. Will think it's very interesting, and would love to write more content within our site, and then they can get more attraction and gain more attention from market.
Since you're the CFO, I got to ask you about your cash pile. I think you have a pretty strong cash position of nearly about 5 billion RMB or so. Yeah. Any plans to deploy that cash, and where?
Well, we have a lot of the cash. So we will do buyback, definitely. So we are one of the company that doing the buyback the most in terms of the percentage. So we're one of the company that done this significant buyback before. So we definitely want to do that. And then we are thinking of some ways to utilize the cash for sure. Yeah.
We got to leave it there. CFO of Zhihu, they're joining us from our Beijing studios. We got plenty more ahead. This is Bloomberg.
Welcome back. You're watching The China Show. We're also coming to you live out of the UBS conference taking place here at the Four Seasons in Hong Kong. Let's talk about the Chinese premier's trip. Li Qiang, of course, has rallied this group of Southeast Asian and Gulf states to deepen cooperation there while touting China's economic strength. Let's bring in Avril Hong in KL for us, where Li, of course, attended the ASEAN summit. Avril, what exactly is China calling for? What have we learned?
Yeah, David, if you think back to last month when the Chinese president was in Southeast Asia in his tour, right, he touted this idea of one united Asian family. And I think his premier, his second in command, is kind of taking things a step further by talking about the three sides, ASEAN, GCC, China, forming the sort of big market and urging them to develop it. To his point, there's a lot of potential here, $24 trillion in terms of GDP combined, and they account for about a quarter of the global population. And we've been discussing this, right, how seriously China's been taking all this. We actually briefly interacted with the NDRC chair and the PBOC governor Pang Gongsheng as they were entering the ASEAN-China GCC summit. So I think that all just speaks to the high level of dialogue that is really taking place here in Kuala Lumpur. And of course, it seems like they have this sort of global realignment of economic alliances. That seems to be what's underway here. Li, though, did acknowledge that when it comes to the different phases of development among some of these countries across the three regions, that poses a slight issue, but he said that shouldn't get in the way of things.
And you've been talking to a lot of the big guests there. What does this mean for capital flows into Malaysia, for example, especially amid this Sell America theme?
Absolutely, Yvonne. I mean, Malaysia is seen as one of the key beneficiaries among the emerging markets. If we see further sell-off in U.S. assets, see any acceleration of that trend. And I spoke to the CIMB Group CEO, Novan Amiruddin, who is, of course, the chief of one of Southeast Asia's largest lenders. And he pointed out that, and along with that, he says that Malaysia stands out also because of its structural reforms. Take a listen.
I think we're entering an extremely interesting times. Foreigners hold about 37 trillion US dollars of US assets. And if you think about it in perspective, right, the US population of global population is about 4 or 5%. US equity markets over global equity markets is close to 50%. But US share of financial assets, of global financial assets, is 70 over %. For 4% population, capturing 50% of equities and more than 75% of financial assets. Of that size, foreigners hold 37 trillion US dollars of US dollar assets. Even some changes on the periphery, some unwinding on the periphery, it doesn't need to be large, it may not be large, but even a 10% change, for example, will see a lot of capital being freed up. In the case of 37 trillion US dollars, if it's 10%, it's 3.7 trillion US dollars being freed up. That money needs to go somewhere. That money, in my view, will go to the emerging markets, and I'm positive that ASEAN and Malaysia will capture a part of that liquidity I mentioned.
You talk about, that capital coming to ASEAN, Malaysia perhaps the beneficiary of this, because in terms of when you look at the lay of the land, maybe foreign outflows compared to other Southeast Asian countries maybe haven't been as bad. The ringgit has been stable as well. Do you think all this is enough for investors to perhaps look at Malaysia and view it as a sort of safe haven?
Well, based on our discussions with foreign investors today, investors are looking for various things. They're looking for political stability. We have that in Malaysia. We have reached that maturity where we're now operating in a coalition government. The government is doing all the right things. Despite maybe, over the last 1 year, you would see some equity outflows, but then we're seeing similar inflows into the local bond market. And inflows into the bond market demonstrates the confidence of investors in the country itself, rather than any specific corporate per se. So we have all the parameters, that in my view tick the boxes for investors as they look at asset allocation and investments. So as a result of that, I do see Malaysia standing out relative to other markets.
So Malaysia markets poised to benefit amid these structural reforms, guys.
All right, Avril, great stuff, and thanks for bringing that interview to us. Avril Hong there joining us. We got some lines that are crossing here from the Ministry of Commerce in China. So it looks like the China and European chip companies did, in fact, hold a meeting. So what we heard from that was that they will maintain stability of the global chip supply chain, and they will continue to support Chinese and European semiconductor companies, and they firmly oppose unilateralism. So that certainly are some of the comments there. We have seen the likes of China as well as the EU talk about more talks here and really try to have more engagements there as they try to push back against Trump's tariffs in some ways. So certainly we'll continue to watch the chip space here today. We got plenty more ahead. This is Bloomberg.
Welcome back. You're watching the China Show. An update here of SpaceX and the colossal Starship here has suffered a leak. It tumbled out of control in space, exploded during this test flight. It's a third straight major setback here for Elon Musk's company. Let's bring in Paul Allen, who's been covering the story for us here. Paul, what exactly happened? And we did also hear from Elon Musk just in the last hour in terms of how he's framed this setback in the broader scheme of things.
Yeah, let's talk about it in two parts, David, because the rocket is in two parts. We'll start with the booster. This was quite interesting, refurbished booster. It had been had flown before on Flight 7. The intention was not to catch it with the chopstick arms at this time, but to test a number of different landing profiles and then have it splash down in the Gulf. That didn't happen. That exploded on reignition for a final landing burn. The second part, the top section of the ship, the Starship, also did not go to plan. There was no deployment of the dummy Starlink satellites. There was no relighting of the engines in space. And then the ship lost attitude control. We did hear from Elon Musk, as you say. He said, look, there were leaks that caused a loss of main tank pressure at the re-entry phase, and that ship was also lost. So not a great day for SpaceX. Test Flight 9 not going to plan.
Paul, I mean, this all comes on the backdrop of him, Musk returning back to his companies after a stint in the White House. What's next then? What can SpaceX do to kind of renew their new focus, or what's going to be the next plan?
Well, not what's next, is they just keep on going. And there's always a temptation to frame these sorts of, setbacks as major disasters. They're not really. This is just how SpaceX rolls. It iterates loudly, publicly. It's not afraid to let things blow up. And that's kind of what we saw today. We have to remember that at the Starbase there in Boca Chica, there is a whole production line just turning out ship after ship, booster after booster. And every time something like this happens, they take learnings from it, they redevelop, they reiterate, they go back to the launch pad, and they try again. Elon Musk still got some very aggressive timelines around this. He hopes to have robots on Mars next year, which is the next launch window for Mars. During this launch, however, we were speaking with a former astronaut, Colonel William MacArthur. He's a little bit skeptical of these timelines. He says getting to Mars still potentially decades away. He says SpaceX might even need to design a new propulsion system that doesn't yet exist. But this objective of getting back to the moon seems to be a little bit more realistic, and this is certainly not the end for SpaceX. They'll be back on the launch pad for Flight 10 before we know it.
Paul, thank you, Paul, on there with an update on all things SpaceX. Another check of the markets here, watching, of course, some of these Asia chip stocks here ahead of that NVIDIA result, right? So certainly a lot of expectations on what this means, particularly when it comes to tariffs and restrictions on those H20 chip sales to China. That should be top of mind. The chips are doing this here right now in the region. Samsung is actually seeing a recovery of about 4% here. Taiwan Semi is up some 1%. So the chips are doing quite well right now. In terms of what we're looking out for, the dashboard is looking like this in China. Of course, we're talking about RBNZ. That's going to be coming out in just about 6 minutes' time here. That decision expected to cut rates for a sixth straight time. Equity markets are doing quite well, but we're seeing just modest upside onshore and offshore here in Hong Kong. HS Tech catching a slight bid here this morning. We got coming up more from the UBS Asian Investment Conference. Dave will be talking to the Chief Global Equity Strategist. This is Bloomberg. Welcome back to the China Show. Here's a look at the HSI half hour into the session. You take a look at how markets are. We're basically off some of the highs here, and we're seeing just a slight upside here, about a tenth of 1% when it comes to Hang Seng. And certainly a lot of talk about the RBNZ decision that happens in just about a minute or so. We'll wait for those lines to cross once they do, but largely expected to cut for a sixth straight meeting there. Whether they lean towards more of a dovish sort of cut or not, that certainly is what the market is anticipating here this morning. But H shares are doing a little bit better this morning, Dave, and we're focusing a lot on the tech sector as well. You take a look at how Xiaomi, Kuaishou, Bilibili, Tencent Music, NetEase, these are one of the big sort of moves that we're seeing, and why HS Tech is doing pretty decently well here right now. Kuaishou was a beat on earnings as well. Xiaomi certainly did deliver on their results, but really a very different story from what we saw for the likes of PDD as well, which did drop overnight here, just given the concerns around tariffs and the impact on that company in particular. Take a look when it comes to the RBNZ. Fed official cash rate, there you go. They did cut here for a 6th rate meeting by 25 basis points. That official cash rate is now at 3.25% here, as seen by most economists here. So no surprise when it comes to the RBNZ. We'll see what the statement says, Jess, in terms of the guidance and what the RBNZ is really thinking about. But they do have some projections in terms of annual inflation in the third quarter. There will be at 2.7%. That average official cash rate in the fourth quarter will be around 2.92. So it seems like they are continuing on this path on easing here. So it might be a bit of a dovish tilt here. We'll see. There you go. So they see the average cash rate falling to a low of 2.85%. That is an adjustment from what we saw earlier of a 3.1% projection there. So there you go. They might be seeing further cuts. This is certainly one thing to watch out for. So at least one more for the year of another quarter basis point cut there. So certainly that's one thing to watch. Some lines crossing through here right now. Well placed to respond to domestic international risks here. Obviously, when you take a look at how the Kiwi dollar is doing, we're pairing some of the losses after that RBNZ rate cut as well. But given just the dollar's weakness that we've seen, we've been talking about central banks around the world. There's a lot more cushion now and window for them to actually implement more cuts. So certainly that's maybe what the RBNZ is doing here as well. So that's what the price action is doing here. It's just slightly downward there on the Kiwi, but we'll continue to watch more. And we'll be speaking, of course, to the governor himself on Tuesday in his first broadcast interview with international media since his appointment. Dave.
Oh, yeah. Oh, check that out. Yeah. I didn't know we were going to do that. Okay. Well, stay tuned. Stay tuned for that one coming up. Yeah, and so we have at least one more coming out of the RBNZ. We learn things on the fly sometimes here, don't we, Yvonne? And we're waiting for the first one next from the Fed, if that makes any sense. But in any case, of course, on your screens right now, 881 on the MSCI All Country Index. And as you can see, Liberation Day is quite visible, this recovery, and then some more. So we'll have an understanding right now, in fact, of where we go from here with equity markets. Now that, if you think about it, we've kind of reset on price here compared to where we were just before, of course, we went into April. Joining us here on set is Andrew Garthwaite, of course, Chief Global Equity Strategist at UBS, to help us paint that blue sky scenario. 880 is moderate. We get to above 900 in a blue sky scenario. Joining us here to talk us through that, of course, is Andrew. Very nice to see you.
Good morning.
So we just set you up there by saying that we're effectively at the target in a moderately, would you describe it? Moderately easy tariff scenario?
Yes.
Yeah. And yeah, so what's the...
the blue sky scenario we have is 940 at MSCI Acqui World, which is about up 7% from here.
Yeah.
And that really comes down to four reasons. One, even more moderation in tariffs than we have today. Secondly, policy response outside the US. All central banks outside the US, apart from Brazil and Japan, are cutting rates. And we're getting a significant fiscal response both in China and in Europe. Hence our Chinese GDP forecast today is the same as April the 1st. Thirdly, the well-behaved nature of US wage growth. That we think will allow the Fed to cut in September and follow that up by 3 further cuts. Now, if the Fed cut 4 times this year and other central banks apart from Japan and Brazil are cutting rates, then the market will look for NEV in earnings. Also, the well-behaved nature of wage growth helps protect profit margins in the US. And finally, I do think there can be some exceptionalism in the PE due to Gen AI. So really, the blue sky scenario is more moderation in tariffs, policy easing, both fiscal and monetary, outside the US, well-behaved wage growth allowing the Fed to cut more than the market expects by year end, as well as helping protect margins, and some exceptionalism in PE due to Gen AI.
A lot of boxes to tick there, to your point. You're focused on Europe now and China. Tell us why those two are your bull cases.
Just in terms of those boxes, 3 of those things are going to happen anyway. Right. The debate is how moderate do tariffs become? And the debate there is whether the art of the deal is to say tariffs are ideological to have bargaining power. Okay. But when you look at it logically, you should end up with more moderate tariffs, to put it bluntly.
Yeah, than the current level. And the scenario on the Fed, since you talked about that, then you say 4 Fed cuts. What gets us there, I guess, is the question. And
well, the house view from Jonathan is they cut in September, which is more or less in line with the market. Obviously, they need to make sure that the rise in consumer expectations of inflation don't become embedded. In my opinion, the fact that wage growth is so well behaved, the voluntary job quits ratio, one of the best lead indicators of wages according to Yellen and Bernanke, is consistent with 3% wage growth, and the market expectations of inflation are very well behaved as well, allows the Fed then to look through a spike in inflation and react to slower growth. UBS had GDP in the US slowing from 2% year on year at the moment to 0.9 year on year end. So they react to that slower growth. Effectively, it's a soft landing.
You mentioned the bull case for Europe. How do we express that? That's one of your overweights.
Yeah, I mean, first of all, why, and also, how to invest in it. I mean, put it very bluntly, next year we think growth will be on a par with the US. That only happens 9% of the time. And when it happens, Europe is 10% more highly rated than it is today against the US. Secondly, when you look at all valuation measures, it looks abnormally cheap. The one we particularly like to look at is dividend yield plus buyback. That used to be well below the US. It's now 1.5% above the US. And thirdly, the positioning is still abnormally cautious. Indeed, on the UBS crowding data, it's the least crowded market. Well, of course, the US is the most. How do we express it? Because we are also bullish of the euro, we're buying domestic Europe. We like, on the defensive side, the telecoms, but on the cyclical side, we've been overweight European banks for 2.5 years, and we like European retailing and the budget airlines. We particularly like sectors which cost in dollars, which benefit from a stronger euro.
And the case on China? The whys there, the whys.
China's very simple. I think it really comes down to 4 things. One, the dividend yield is on a par with the high yield.
Yes.
And when you look historically or in China, that's almost always a buy signal. Secondly, you've had a sharp improvement in earnings momentum in China relative to global markets, in spite of pretty weak nominal GDP growth of 4.5%. So earnings are decoupling from the macro cycle. Thirdly, we think there's a good case for excess liquidity. TSF, total social funding, is growing at 8.7%. That's nearly double nominal GDP. When you get excess liquidity, it doesn't go overseas because of capital controls. It's probably not going to go into housing, given the state of the housing market. It goes to financial assets. And finally, look at positioning. I mean, it's worth considering that the MSCI weighting in China is below that of Apple, and the actual weighting we think in China is 1/20th of the US and 1/3 of Apple. It really
That's
doesn't.
crazy. Well, you put it that way.
When I started,
Apple, yeah.
Japan was 43% of the world, MSCI world. Now look, it's barely 5.
Yeah.
So sometimes common sense pays. You go back to the early 1990s, the second largest bank in Thailand was bigger than JP Morgan. So sometimes, a bit of a common sense smell test. I also think when you look at China, tech, according to the Australian Strategic Policy Institute, leads in about 70% of the fields it's in. We've got lots of anecdotes, of course.
Right.
It's abnormally cheap, earnings momentum is good, and you've had a reassessment of, quote unquote, the 2 unshakable principles, i.e., shall we say, less problematic corporate governance.
That takes us now into what do we do with the U.S.? What is the appropriate weighting? Where do we land in that sort of scenario?
Yeah.
And, offline we talked about how you guys are index weight. There's a chance that the U.S. market's underweight. The underlying question is what should be the index weight of the United States?
Yeah, I mean, if you look at MSCI Acqui World, it's about 63%. The US is 27% of global GDP. It's 16% of global trade. Looking at it very simply, particularly given the previous discussion, it does seem structurally emerging markets are underrepresented on any method of people, GDP, innovation relative to the US. I think we'd look at that, logically. While I admit with benchmark, I see more risk of underperformance than outperformance. And the concern I have is that normally the US outperforms when global growth slows because it's got the lowest operational leverage amongst other things, or when the dollar weakens because 28% of earnings come from outside the US. The problem is this time the slowdown in global growth is led by the US, and the Fed are more reactive initially. And normally as global growth slows, bond yields fall, and growth stocks being long duration outperform. That's not happening this time. Falling bond yields see growth stocks underperform. And as for the dollar, yes, a weaker dollar a priori is helpful, but this time around the dollar weakness is a part of a sell-off of US assets, so that relationship is working less well. And when you look at the US, what do you have? You still have an exceptionally high valuation. The sector-adjusted PE is 30% above its post-2010 norm. You have an exceptionally bad fiscal position. You have an exceptionally bad net foreign debt, which is nearly 90% of GDP. It was single-digit 25 years ago. And buybacks, which used to be the lifeblood of the US, as a proportion of market cap, are now on a par with Europe and Japan and below the UK. They used to be much higher. So a lot of those drivers which were there are relatively not there.
Yeah, and to your point, things are not behaving traditionally when you look at the bond yields in a dollar story. I think you've laid out quite a strong case. Andrew, thank you so much.
Thank you very much.
For spending time with us. Lots more to talk about next time. We'll do this again, this time next year.
Thank you.
You could do a sporty tie next year. Well, yeah, we were just commenting on each other's ties early on. Andrew Garthwaite, their Chief Global Equity Strategist at UBS. We'll have plenty more ahead coming through here at the UBS conference.
All right, take a look at when it comes to, it's mid-year, right? So it's time for a pulse check of how things are looking. And Eastspring Investments just released, in fact, their mid-year market outlook and saying that they see greater upside potential for Asian and emerging markets as the dollar weakens and investors look to diversify. Let's bring in their CIO, Vis Nayar, joining us here in the region. It's good to have you here.
Good morning.
In Hong Kong. Yeah, I mean, there's so much talk about diversifying away from the U.S., this whole kind of de-dollarization theme. Where do you stand on that debate right now?
So look, I think we've seen a real concentration of capital and assets and investors looking at the US for a number of years now. So as the dollar weakens, as US growth is more challenged, as valuations are high, we can see, and of course we've also seen some tantrums in the fixed income markets, we can see global investors moving away and looking beyond the US. And in that journey, we can see the dollar coming down, and we can see more interest in some of the Asian economies that we think are poised to do well.
Is it a structural sort of unwind that we're seeing here right now? I mean, how much further does it have to go, especially for the dollar?
Right. So look, we've seen dollar weakness this year, and if anything, we've seen that the US market has also underperformed some of the larger Asian markets this year. So we think that's the beginning of something bigger. So I think that the dollar domination in those global markets has perhaps started to unwind a little bit. Last year we were looking at things that were priced to perfection. I think there's a little bit more disappointment to come. There's a lot of uncertainty in markets, and in that uncertainty that's leading people to think a little bit more about diversification.
How about the equity side of things? Because they've actually stayed quite resilient in the US.
Yes, it's a V-shaped recovery, as they call it. I think there's a disconnect, between the equity markets and the fixed income markets. We're seeing much more of a tendency for investors to perhaps be on the sidelines in the US market. We've seen some worries about the fiscal policy there.
Yeah.
And I think that from the equity market context, we have seen a resilience there. But at the same time, I repeat what I said earlier, the US market has underperformed this year, despite that resilience. And I think it's us imagining that is likely to continue.
I have to get your take on JGBs. I mean, I know you don't focus it too closely, but it really has ripped across these global bond markets. It's even a spill over to treasuries, to Australian bonds as well. Why do you think Japan's bond market has been such an influential force now in global bond markets?
So I think if you look at the global purchases of U.S. treasuries, for example, Japan is right up there. Now, in terms of the economy itself, they're a nation of savers. When JGB rates start, really rising in a material way, there's much less of a desire to go overseas. And I think that's the real challenge. If that demand for U.S. treasuries starts to come down, we start to get really quite concerned about that.
Is there a real risk of then repatriation back to Japan, given how yields are now?
More that the investors don't need to go abroad, right? So those rates are significantly more interesting now. I know that they're not where they were 30, 40 years ago, of course, and I've seen these longer-term graphs, but still materially attractive now compared to where they've been for a couple of decades.
So how should I look at making a portfolio then this year? If it's diversification away from the U.S., where to?
So we've just heard the previous sort of segment as well. The US is a very large part of the indices, but much smaller part of the global economy, of global flows. We've got a lot of risks in terms of policy, in terms of the uncertainty that brings, and you've got a US market that's highly priced for perfection. So against that backdrop, clearly there are sectors and countries that think they're poised to do well. We've heard something about Europe earlier, but of course in our world we think much more around the opportunities for India, which is much less exposed to the kind of exporting to the US. They're much better positioned, we think, to do well from doing a trade deal. China is in a great position because, again, the markets have responded well this year. They seem to be very clear and focused on the policies demanded. Tariff rates might be slightly higher than they were, but if that's a drag on GDP, we think that they've already introduced 2% stimulus. We think they might do another 1 or 1.5%. We see them tracking another 4.4%, something like that this year for growth. So again, very interesting pockets and sectors. We do not think it's a market-wide recovery. We think that there will be specific companies and sectors that do well. Yeah. And the key for investors is to be active. We keep saying that in our outlook. That was a theme of the outlook. Think Asia, think active. The opportunities are not at the index level. Yeah. You need to find those best companies,
you mentioned
resilient companies.
To caution not to be too bearish on China, in particular the equity market. How much exposure should an investor have now then?
Yeah. So I think that we've just heard that in the segment. China is woefully underrepresented now. Market correction meant that it's down in the single digits. We need that. We think you can reasonably have a much wider exposure. Now it depends on the appetite to move away from the US. I think that. US at 60 plus of a global index, even if you're 5-10% underweight, that's still a material allocation to the likes of India and China. And that's how we would think about the problem. It's not that you divest from the US entirely, but we think the marginal appetite to invest in the US reduces.
India, I mean, it's always been expensive, but what is the counter argument to that?
The counter argument is that they're in a great position. They're not exposed to the US, the president's policies like some of the other markets are. They have a great domestic economy. A lot of companies that focus on the Indian consumer as opposed to the foreign consumer. There are a lot of policies. They're in the right place geographically. In terms of security and global issues, I think that they have a good interaction with the sort of major agents in that. So I think it's just demographically and otherwise, just in a great position. Now, of course, valuations are being part of the challenge and the headwind, but we've seen already some corrections in 2024. We now see the RBI able to now reduce interest rates, carry on with that policy. So they're in a great position, we believe, in the cycle to cut rates and therefore do well.
What assumptions are you making in terms of tariffs then? If that's still going to be the, mid to long-term risk on the radar? Is what we're seeing right now 10% or 30% on China? I mean, are those the baselines that you're assuming here right now?
So essentially that seems to look like an endgame, 10% across the board. China's got this extra 20% plus some sector specifics. So we think that for the likes of China, that perhaps is a 1% headwind on GDP. Now, they might be able to have the growth to still be an interesting investment opportunity. I think there are some countries that are perhaps very materially exposed to the US in terms of trade, And it's much harder, perhaps, to strike a deal that works well for them. But the likes of India, China, you've seen that with Japan as well, they're holding out for good deals. And I think that we can see that takes time, but we'll get there.
Vis, it's great to have you here in Hong Kong. Vis Nayar, there, CIO of Eastspring Investments, joining us here in our Hong Kong studios. We got plenty more ahead. This is Bloomberg. Here are some of the corporate stories that we're following for you today. Bloomberg has learned that HSBC has cut more than 24 analysts, including its head of fixed income research, Stephen Major. Sources say most of the cuts were in Europe, and we're told the changes involve combining macro strategy across asset classes, including foreign exchange and fixed income. The restructuring is part of the CEO's efforts to streamline the lender and increase efficiency. Bloomberg's learned that Ray Dalio will not be an advisor to Indonesia's new sovereign wealth fund, Danantara. Sources say the Bridgewater Associates founder opted out in March, even as the fund publicly touted his appointment. The reason is not immediately clear. Dalio's absence is a setback for one of President Prabowo Subianto's flagship initiatives as he tries to supercharge the economy. The U.S. government is said to be poised to receive a so-called golden share in U.S. Steel as a condition for approving Nippon Steel's acquisition. Sources say the plan would give Washington de facto veto rights on certain company decisions. The scope of the veto powers remain unclear. President Trump announced a partnership for the deal last week, including $14 billion in new investments.
Right, just a check of Tayo Holdings. This is after reporting that, and as you can see, the shares are reacting, and then there was a glut of buy orders as those orders came in. So we're effectively stuck at about 4% going into the Japanese lunch break. This is a Japanese chemical manufacturer, and we understand that it did receive buyout proposals from two companies, including KKR. We'll get you more details once we have more information, but as you can see, markets already reacted. Very quickly, before we head into the break here, we're looking at the TAIEX index on the back of this downgrade coming out of Nomura, and we're effectively at session lows there on the TAIEX index. Plenty more ahead.
.29 a.m. in Tokyo. Japanese markets are going to that lunch break in just a minute. But again, we are still bracing on tenterhooks about this 40-year bond auction that's happening in Tokyo today. Certainly one to watch. So equity markets are doing okay. It's really focused on the long end of the JGB curve right now. We're still up now. So we reversed a little bit overnight after what we heard from this chatter from the Ministry of Finance that they're looking into adjusting the supply and issuance of bonds. Yeah, that certainly gave a little bit of relief to the market. But then again, we're seeing yields pick up once again across the long end. Let's bring in that board and show you how things are doing. So it certainly just goes to show the swoon that we're seeing across some of these bond markets. But yes, at least the 40-year yield is stable. But we are seeing yields tick up slightly higher on the 10s, the 20s, and 30s here this morning. Let's get more analysis on what to expect from this bond auction today and bring in our very own Garfield Reynolds, who leads our Markets Live coverage in Asia. Garfield, it looks like this could go either way. And really just a flip of a coin. What's going to happen today?
Well, the most likely outcome is that this will be a solid auction, and that might lead to some fresh declines in yields across the curve, or at least a stabilization. We saw some nerves at the open where we had 40-year yields jumping, 20s as well, and even 10s went up a fair bit, but that cooled off. You're talking about a market that ultimately is very open to manipulation. The BOJ owns more than half of all Japanese government bonds. That's excluding T-bills. It owns fewer of those. And you have this tradition of Ministry of Finance, backdoor whispering, as it were, to keep traders from getting too out of hand. So in that context, it would be a real surprise if we got a noticeably weak auction. It would probably be a disappointment if the bid to cover fails to move up from last time round. And last time round, the 40-year bid to cover, that's the amount of bids placed relative to the amount of bonds that are being sold, and that climbed last time to the strongest in quite a few years, close to the strongest since 2020. So if we're looking for something close to or just above 3 times as many bonds offered to buy as are on sale. If we don't get that, that might be that, well, it's not a solid enough auction. That could signal that there are still just too many concerns lingering amongst investors, especially. We do have some inflation data coming up later this week that could emphasize the risks both of fresh BOJ tightening and of high inflation, meaning that investors want higher yields before they're willing to buy super long debt.
Garfield, I mean, just to broaden the view here, because I mean, certainly the timing of this global bond rally going into this auction is, I guess, encouraging if you think about it, because we can't afford another weak auction when you look at price action. So, the rally we've seen in global yields, Treasuries 30 years back below 5%. I'm just looking at my screens right now. We're currently on the 30-year at, let's call it 496. Is this simply repositioning? Did things just get too extreme to the downside, or has there been a change in the underlying narrative here around the bond markets?
I don't think there's been a change in the underlying narrative at all. The underlying narrative is that with inflation globally still sticky, concerns about sustainability in the US and Japan and Europe as far as the amount of borrowing that's being planned, with yields still at relatively high levels, all of that means that the most likely path higher for most global bonds, including treasuries and especially JGBs, is higher. The whole question is, how rapid is that move higher? And I think you've actually got, it's a pretty concerning sign, the way that you've had these 2 very poor 20-year auctions in Japan, in the US. That's a much unloved area in the bond curve. Not everybody sells at 20 years. So that's underscored the concerns that are there under the surface. And for Japan to have to do so much apparent arm twisting with this 40-year sale, that just highlights that the risks are there for increased volatility, that yields are going to move higher, and there's plenty of concern that that's going to degenerate into another melt-up in yields, such as we've had on several occasions over the last couple of years, and more of those occasions over the last 6 months or so.
That's a good reminder, Garfield, that we did get some commentary coming through into around this time yesterday in the JGB market. Hence, we're here looking quite favorably compared to, let's call it 48 hours back on this auction coming up. Garfield, thank you so much. Garfield Reynolds there, who leads our MLive coverage here in the Asia Pacific. How my life has taken quite a sharp detour. Me waking up genuinely excited to check out and see the results of a 40-year Japanese government bond auction, and what the bid to cover ratio wasn't done, what the tail would look like. Anyway, speaking of central banks, interest rates, are they coming down? That was really one of the points of discussion we had with our exclusive conversation with the UBS Asia Pacific President, Iqbal Khan, who was here earlier on set, who talked about how, while rates are expected to come down, it's really also about the timing of when those things really start to come to fruition. Here's part of that conversation we had here at the UBS Asian Investment Conference.
While risk has come down, there is a continued potential of stagflation. However, things have moved on. And I think one of the calls we made early on, and actually already coming into this year, around diversification, and diversifying across geographies, currencies, sectors, has worked out really well. So diversification it is, and diversification remains a key theme for investors and for building better investment portfolios.
Yeah, and I think certainly with the facade of U.S. exceptionalism started to go away, you are getting more portfolio flows coming out. What are you seeing as far as wealth flows are concerned, to the point you're making on needing to diversify, especially now?
Look, clients are looking at this world coming into 2025 and seeing that having a more diversified portfolio, thinking about how you allocate capital in different currencies, different sectors, but of course regionally as well. Look at the European indices, look at Hang Seng just here in Hong Kong. Yeah. You look at these indices, you are clearly, if you're thinking about the equity space, think about diversification, think about the bond market as much as, of course, alternatives. So fundamentally, we've been very much focused on helping our clients invest on a diversified basis, and I think that's working quite well. At the end of the day, in an environment with a lot of volatility and uncertainty, while we have a pause around tariffs at this point in time, there will be continued volatility. We expect continued volatility. And in that perspective, I think being diversified, thinking in scenarios, that is absolutely key. And that's what we're helping our clients think through, work through, and help them invest accordingly.
Is the assumption for rates still to go down?
Well, look, I think we are starting to see inflation numbers come down to some extent, right? Having said that, there clearly is a perspective of timing around rates. We do continue to expect that rates will come down. It's a question of time, and of course, as we see further data come out, and also just let's not forget the uncertainty we still have around tariffs and the environment itself. So I do feel that while we will see rates come down, it's a question of timing.
Right. And it's puzzling to us sometimes. To your point, you look at the equity benchmarks in Europe, you look at here in Hong Kong, it's as if nothing happened in April. You know, we're back to those levels before those Liberation Day announcements were made, and even more. But the bond markets seem to be dancing to a separate tune. We seem to be getting higher and higher yields on the long end. Which asset should I believe?
So look, I think what is interesting clearly is after some of the adjustments and some of the events that we saw earlier this year, even S&P is at more than 5,900, so actually higher than when we started this year. And yes, absolutely, European equity markets as well as Hang Seng are doing quite well. In the bond market, or overall long-term rates, of course, are impacted by fiscal policy and of course also what is to come, specifically in the U.S. when it comes to the U.S. budget and anything around deficit and the overall plan that is to be implemented. I think you're seeing that impact more on the longer rate curve.
That was our exclusive conversation with the UBS APAC President Iqbal Khan here at the UBS Asian Investment Conference. Checking some movers here. The tech space definitely is seeing a lot of price action here today. Take a look at Kuaishou shares. So earnings came out that Kling AI is starting to see some, I guess, bear fruit, I guess you should say. And so there's some progress in terms of monetizing that AI model. So the shares are up close to 5%. We're off some of the initial movement of the stock so far, but certainly does bode well. But some analysts are still expressing some concern about that rising AI-related investment and that drag on margins and profit throughout the year. But certainly the stock is doing quite well here today. We're also looking at China healthcare stocks in particular here. So we continue to watch biotech do quite well in this market. There you go. We're heading the opposite direction here today. Morgan Stanley, the latest there when it comes to lowering Ali Health. So that certainly is leading the rest of the sector lower. Ali Health in particular is down 1.5%. Plenty more ahead. This is Bloomberg. Take a look at our big take here this morning, certainly one that we've been talking about with our guests for weeks and months now. President Trump's efforts to remake global trade by bringing factories back to the U.S. is threatening a $7.5 trillion worth of investments from Asia. That is the subject of our big take here today. Let's bring in our senior reporter, Ruth Carson. She joins us live from Singapore on her story. And certainly it's been something that you guys have been talking to a lot of guests about. And the fact that, you know, Trump's policy is really turning U.S. markets from a once beloved destination of Asian investors to now actually a source of volatility and pain.
Yeah, absolutely, Yvonne. It's such an important story to tell. It's important to remember that we're not talking about little amounts here. We're talking about $7.5 trillion worth of US assets at stake. And it's interesting in the sense that this pile has been growing for decades now. And for the first time in a very, very long time, investors, real life, real money investors like pension funds and also life insurers are seriously rethinking if there is a true over-reliance on everything from treasuries to US stocks. So we're seeing this soul searching really ripping across all of Asia. For example, Nippon Life looking for alternatives to treasuries, and they're Japan's largest life insurer. You've got family offices, tens of them across Asia, either freezing investments in the US or even cutting back. And you've seen official data showing that China has also been reducing its treasuries holdings. Now, all of this is amalgamating to one question. Is there an over-reliance, and what are we to do about it when it comes to investing in the US because of all the trade wars and how Donald Trump is upending global trade?
Yeah, a soul-searching indeed. Ruth, you mentioned what's at stake. What exactly are the assets at stake here? And what could happen if Asian investors increasingly turn their backs on treasuries and US equities?
I think that's the key multi-trillion-dollar question here. We're talking about $7.5 trillion. That's what we know. That's the entire pile. But since the Asian financial crisis, 11 of the biggest economies here in this part of the world have amassed about $4.7 trillion, our analysis shows. Now, these assets span everything from credit through to treasuries, through to US stocks. And as that rethink continues to happen, we're already seeing real-life examples of the vol that can happen and that can just explode across markets from Asia, stemming from Asia, as that rethink continues. A couple of examples, the Taiwan dollar that we saw, skyrocketing to the highest levels since the 1980s in a span of hours earlier this month. We've seen massive treasuries vol immediately in the aftermath of April 2, also stemming from this part of the world. So brace for more is the key message here.
I'll tell you the story then. All right. Ruth, thank you so much. Ruth Carson there, our senior reporter in Singapore. By the way, subscribers can check out that story on the Big Take today on this de-dollarization taking place right now on the terminal NI Big Take. It's also up on our website, of course, for those who want the online version of that as well. Right. As you guys might have caught there on our mics, we were just bantering here with our next guest coming through here and what the situation actually looks like moving forward. We have really one of the foremost experts in global trade joining us now, and even then, we're scratching our heads really on what's taking place after this right now. Let's bring him in. Let's bring in Pascal Lamy, of course, here on set with us at the UBS Global Investment Conference. Asian Investment Conference, to be more specific. So, what happens? What happens now? How does this all end? You just finished a session on stage, and are we any closer to an answer to those questions?
No, I think we have to look at beyond the sort of day-to-day bumpy new announcement, increase, decrease, forward, backward, and try and look at what the end picture for global trade is. And my sense, for what it's worth, is that we are moving to a sort of new normal. We will remain globalized. Okay. Trade flows will still crisscross this planet, but with a different U.S. position. The U.S. economy will be operating within a sort of tariff fence of somewhere between 10 to 15%, which is very high compared to the previous situation. And the rest of the world economy will have to adjust. Plus a series of higher bilateral tariffs between EU and US and China and US, of course, sort of 30% bilateral between US and China, let's say 10 to 15% bilateral between EU and US, but the system will adjust. What does not go anymore to the US because of the tariff protection will go elsewhere. There will be trade deals between EU and Southeast Asia, between EU and South America in the case of the EU, that will in a way compensate for the relative closure of the US market. And at the end of the day, unfortunately, less open trade is less efficiency, which is less growth.
Right. So, on aggregate, it seems, on aggregate globally, we'll be at about the same level. It's just that we'll be doing less trade with the United States if structurally after this, the operating environment will be higher tariffs. I'm struggling to think what the upside is for the US.
I'm struggling, like you, to understand what the upside is.
In that scenario of less trade.
There is an obvious discrepancy between what Mr. Trump believes, which is that raising tariffs is good for the US because it will make the US stronger. That's what he believes.
Bring capacity back in, manufacturing.
Whatever reason is behind this, and what 98% of serious economists on this planet believe, which is that this is not the right way to address a series of problems which the US have, and which basically have very little to do with the US global trade deficit.
And just back, I guess, to the here and now, I remember on Liberation Day when Donald Trump, the president, announced across-the-board tariffs. It included the big economies, China, all the way to Europe. It also included very small economies. And I'm wondering, no one's talking about the smaller economies who might not have either leverage or things to bring to the table to get those tariffs back down. And I'm wondering how you're thinking about what about the smaller players in the world?
I mean, I think in these smaller economies, you have two categories. Small economies who are poor, and which, at the end of the day, I hope will be left out of the hook, because it matters a lot for them and very little for the US. And then you have small economies, sort of small economies like Singapore, like Cambodia, well, by the way, not that small anymore, who are in a more difficult position because they don't have the sort of retaliation capacity which China and EU have. And we've seen an example of that with the quote-unquote UK deal, where the UK had, in a way, to swallow a 10% tariff, which is WTO non-compliant, which for a big member of WTO like the UA is a bit of a problem, with a little bit of managed trade here and there on beef or cows. So the big game is with China and EU. I think there is no game, hopefully, for a bunch of 50 very poor small countries, and the rest is somewhere in the what I would watch most in this category is not the very small ones, is the one like Japan or Korea, which are somewhere in between the very big shots and the small ones you mentioned.
At the end of this, are you confident that we will see a deal between the U.S. and China? Can you envision a scenario where this year we will see President Trump and President Xi across each other signing a trade deal?
I think a possible deal is a sort of, let's say, average 30% tariff.
Still high. Okay.
On both sides, which is high. But this is the reflection of the geopolitical component of that, seen from the US, the willingness from the US to decouple with China, which is not reciprocated by China, but that's where we are, but with quite a lot of exceptions and holes that will allow the essentials of what China needs to import from the US and what US needs to import from China to be protected from that. So how much is going to be the sort of trade-weighted final tariff, I don't know, but it's probably going to be a combination of this. Now, whether this happens de facto or whether this is celebrated, that's politics.
Yeah, well,
I don't know.
We'll have to see what the details look like. That sounds like decoupling with the exception of essentials. Pascal Lamy, thank you so much for the time. We'll have more time next time. Lots more to discuss there, of course, with the former WTO Director General here on set with us at the UBS Asian Investment Conference. Plenty more ahead here on The China Show.
HSI reversing initial gains here, actually lower for the benchmark, but we're watching very closely SM Entertainment now with Tencent Music buying a stake in the K-pop bet and maybe people betting that maybe K-pop returning to China through this deal. This is Bloomberg.